For the past decade, Wall Street maintained a definitive narrative. Apple is the undisputed king of tech ecosystems, while Samsung is merely a cyclical hardware follower. Historical data firmly backed this consensus. Up until 2025, Apple's annual revenue and operating profit routinely doubled those of Samsung. They operated in entirely different weight classes. The market accepted it as an absolute truth. Apple owned the high-margin, exclusive lock-in ecosystem, while Samsung shouldered the heavy, low-margin risks of manufacturing. But in 2026, a seismic shift is catching global capital markets entirely off guard, triggering an unprecedented corporate reversal. Look at the latest operating profit data. Apple's seemingly invincible profit fortress has hit a glass ceiling, plateauing at $147.4 billion due to global smartphone saturation and a stagnation in hardware innovation. Meanwhile, down in Suwon, South Korea, Samsung Electronics is orchestrating an astonishing vertical ascent. Propelled by the massive explosion in AI infrastructure, Samsung's projected annual operating profit for this year is skyrocketing toward a staggering $200 billion. Is this just a temporary illusion or accounting luck? The audited financial data tells a completely different story. Samsung has already proven its raw earnings power in the first quarter of 2026 alone, hammering out a jaw-dropping $38 billion in operating profit in just 90 days. As the AI supercycle peaks and next-generation high-bandwidth memory, HBM, supply lines run at maximum capacity, Samsung is doing more than just catching up. It is fundamentally dethroning Apple to become the most profitable tech enterprise on the planet. The AI revolution has effectively supercharged Samsung's core engine. To truly understand the anatomy of this reversal, we must tear open the balance sheets of both giants and inspect their asset allocation strategies under a microscope. What we find is a radical divergence in how each corporate entity treats capital. Let's look at total assets, the ultimate metric of a company's physical weight. For years, Apple pursued a strategy popularized as capital optimization. In plain terms, Apple stopped building factories and halted heavy investments in physical infrastructure. Instead, they weaponized their colossal cash flows to fuel an aggressive financial engineering machine, buying back and burning hundreds of billions of dollars of their own shares to artificially pump their earnings per share, EPS. Consequently, Apple's balance sheet became exceptionally lean. Its total assets flatlined at $371.1 billion. Apple intentionally chose to become a highly optimized, ultra-slim financial fox. Samsung Electronics took the exact opposite path. The megafabs that Samsung relentlessly built even during brutal semiconductor downturns have now transformed into a massive, exclusive toll booth on the global AI highway, collecting premiums from every major tech player on Earth. Apple chose the path of the agile financial fox. Samsung engineered itself into a heavily armored manufacturing titan. In an era where the supply of physical AI infrastructure dictates geopolitical and corporate power, the leverage has shifted decisively to the titan. This brings us to the most perplexing and contradictory anomaly in modern financial history: the valuation gap. Anchored by its monopoly-like grip on the AI supercycle, Samsung recently made history by comfortably entering the elite club, anchoring its market capitalization above $1.33 trillion. Yet, right next to it, Apple commands a staggering market value of $4.53 trillion USD. Confront the raw math of this situation. Samsung is generating significantly more operating profit than Apple, yet Wall Street prices Apple at a staggering 3.4 times the valuation of Samsung. When you calculate the implied multiples based on 2026 earnings, Samsung trades at a measly PE ratio of just 6.6 times, while Apple enjoys a premium multiple of 30.8 times. Why is the market penalizing the clear earnings champion with such a brutal discount? The answer lies in an obsolete, deeply entrenched Wall Street bias regarding earnings quality and sustainability. For decades, institutional investors have branded Samsung with a cyclical scarlet letter. The market views Samsung's $200 billion profit magic as a temporary spike, a volatile anomaly of an upcycle that will inevitably crash back to a $20 billion floor the moment chip supply catches up with demand. Conversely, Wall Street treats Apple's cash flow as an indestructible annuity. Even if hardware sales stall, 2 billion active iPhone users continue to pay monthly recurring fees for iCloud, Apple Music, and the App Store. It is predictable, high-margin ecosystem revenue. Hence, the 30.8 times multiple premium. However, at this exact juncture, Wall Street is falling victim to a massive structural blind spot. The current generative AI revolution is not a traditional volatile semiconductor cycle. It is a fundamental, permanent formatting and overhaul of human civilization's infrastructure. In a standard cyclical market, demand eventually normalizes. But in the era of large language models, LLMs, autonomous computing, and sovereign AI, the baseline requirements for ultra-high-speed memory and advanced foundry processing are expanding exponentially. Samsung's $200 billion profit is not a lucky lottery ticket for this season. It is an infrastructure anchor, a sustainable long-term tax on the global digital economy. When a company locked in a cyclical narrative proves it is actually driving a structural paradigm shift, it triggers what financial theory calls a valuation re-rating. The moment global capital fully wakes up to the reality that Samsung controls the physical heart of the AI era, a 6.6 times multiple becomes mathematically absurd. If Samsung is re-rated to a modest, conservative multiple of just 15 times or 20 times, still significantly lower than Apple, its fair market capitalization immediately surges to $3 trillion or $4 trillion US dollars. This is not speculative optimism. It is standard valuation arithmetic. Global investors now face a fundamental choice. You can trust the historical consensus that chains Samsung's value to old hardware cycles. Or you can look past the surface of the balance sheet, read the footnotes of the global tech shift, and realize that the physical power of the AI era belongs to the manufacturing titan. The data has laid out the divergence. The earnings gap has closed. The throne is exposed. The final judgment, as always, belongs to those who look past the noise and decode the true velocity of capital.